We've been evolving our point of view on Ether. When we started our analysis, we were pretty much, and this was with Chris, Bitcoin was what we needed to understand first. But we were keeping our eye on all of the other assets and stuck pretty closely to the thesis, the FAT protocol thesis that Chris's partner Joel Monegro came up with at Union Square Ventures, which says that the value accrual will take place more at the currency level. And we believe there would be only a few currencies in the world, much like there are today. We thought Bitcoin would be the reserve currency, and we were looking for the other currencies.
It's well known that Cathie Wood and her firm ARK Invest is bullish and has invested into Bitcoin with predictions of it going to $500,000 in the next few years. However, what's lesser known is that Cathie Wood and her firm are also invested in the second largest cryptocurrency, Ethereum, and are just as, if not more bullish for the coming years. In fact, Cathie Wood and her firm are so bullish on Ethereum that they have price targets of over $180,000 per ETH contingent on how much market share Ethereum can grab of various use cases. In her latest interview with Bankless, Cathie Wood breaks down why she's bullish on Ethereum heading into 2023. Make sure to stick around to the end of the video where Cathie Wood also explains why banks such as JP Morgan are terrified of Ethereum and is already beginning to eat into their market share. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Let's see, one of the things that has struck me from the beginning, and when Chris started at ARK, which was very close to the beginning of the firm, I remember saying very early on, follow the developers, follow the developers. Well, using that metric, Ethereum is off the charts, whereas Bitcoin is steady as she goes, still increasing, steady as she goes, but clearly Ethereum, decentralized finance, NFTs have hit a responsive chord. I think bringing the creator community into this ecosystem is, helping it go a little bit viral more quickly than we would have expected.
You guys are bullish then on Bitcoin, bullish ETH.
Yes. Indeed. I think part of the heightened regulatory talk here in the United States and elsewhere, but it's really taken off in the last few months here, is because what you are talking about, the yield, has attracted so much interest that the banks themselves are beginning to feel it. I have been shocked. I listened to especially JP Morgan's call. It's a good kind of staple to understand what's going on in the banking industry. In a V-shaped recovery, Jamie Dimon was telling us that their loan growth would be negative through the end of this year. I said, what? And I began to think, could it be? Could what's going on in the Ethereum world already be impacting banks? Prices are determined at the margin. And so this could be really hurting the banks. And I think I'm going to take a very close look during the next few earnings seasons to see if we can dimension it. It doesn't seem like it is big enough yet. I'm beginning to wonder, the search for yield, which again, the extremes, the bond market in the traditional world, I believe is in a bubble, certainly on the corporate credit side, which is where the risk is. And I can't help but believe that others believe the same and are searching elsewhere for yield, especially the hedge funds. I think part of the regulatory heat that is taking place now is because the banks are beginning to see how much this is going to hollow them out, especially since monetary policies around the world have pretty much become unhinged. And, talk about trust. I think there's more trust in this ecosystem, in the way you've defined it, risk minimized, than there might be in the traditional world. As if we're right, there's going to be a lot of creative destruction and counterparty risk. And these banks are going to be losing share to the crypto world. And I want to get back to that in a moment, because you seem so surprised, and I think it's so obvious, but now I realize what the disconnect is there. But yes, absolutely, I can. And if I could say something, I learned an important lesson it was the currency crisis, the Asian currency crisis in the 90s, 97, I think it was. And the Thai baht devalued. Nobody thought anything of it. Thailand was hardly measurable out there, but it ricocheted. There was an Asian crisis that took place, domino effect. And so we began to ask companies like Boeing at the time, oh, what's your exposure to Asia? It seems as though something's unraveling there. And they'd say, nothing, not even 5%. Well, what they didn't say is it might have been 4% of their sales, but it was more than 100% of their growth. And so when Asia went down, Boeing's earnings imploded in a way that most people couldn't understand, because they said, wait a minute, they told us it was only 5%. Yes, but they didn't say what percent of the growth it was. And I think we're talking about something equivalent here. And so, oh yes, the banks are on. We are on the threshold of an explosion in innovation, and crypto is symptomatic of it. The seeds for what is about to happen were planted during the 20 years that ended with the tech and telecom bubble. Those seeds have been gestating for 20 to 25 years, sometimes 30 years, and are now beginning to blossom. And that's not even the right word. They are exploding into existence. So we think there are 5 major platforms, 14 different technologies that are all getting ready to move into the sweet spot of their S-curves. And there are going to be convergences between and among these technologies. So you're going to have one S-curve feeding another, and creating explosive energy and explosive growth. And I think in the crypto space, we're going to see blockchain technology and artificial intelligence converge and cause explosive reactions. So it's pretty exciting. Just to get back to investing in the future, when I was trying to explain to someone what I wanted to do before starting ARC, and who's not in our business, he said to me, "Oh, you mean that in the future of investing is investing in the future?" And I said, "You got it." Well, now, when I started in the business, that's the only way people thought about investing. And then we went through the tech and telecom bust, and then the 08-09 meltdown. And we ended up with huge risk aversion in the markets and a tendency to invest very much like the broad-based indices out there. In other words, not adding much more value than the indices themselves. And the indices are where they are because of what has happened historically. The largest companies, the most heavily weighted companies in these indices are there because of their past success. But if we're right, and all of this disruptive innovation is about to explode, well, they are in harm's way. Most investors have never seen exponential growth. Well, they recall seeing it once. It was during the tech and telecom bubble, and that ended badly. And that's why there's been this allergic reaction to innovation and high valuations. Most investors have a 1-year time horizon, maybe 18 months. We have a 5-year investment time horizon. The early years of exponential growth, when we're at low numbers in terms of the base, the numbers don't look that much different from linear growth. But when you go out 5 years, the difference between exponential, so revenue growth rates in the 25 to 50% range per year, and let's say GDP growth, which might be 5% at best, night and day. And I think what gives us the differentiation is our starting point. We start from the top down, trying to size markets, and we center our research on something called Wright's Law. Wright's Law is a relative of Moore's Law. Moore's law is a function of time. Wright's law is a function of units. And actually, Wright's law has worked better in the semiconductor industry than Moore's law itself during the last few years. And so that's how we get to numbers like the electric vehicle space, 2.2 million last year. But the costs are dropping to such an extent now that we think that number is going to 40 million, almost half of the global cars sold in 5 years, actually more like 4 years now. No one has that kind of accelerated growth in their models. They've never seen it before, so they're not modeling it in the future. But Wright's law is a very good guide.